Hello and welcome everybody. Welcome to Sectors Made Simple and Step into Sectors video number 4. Today we're going to continue where we left off last class and continue talking about backtesting and all of the ways that we can use backtesting to inform our investment strategies. So before we get into today's material, really quick disclaimer. Everything we share here is meant for educational purposes. We look at historical data to try and understand what might happen in the future, but with any type of investment strategy, past results never guarantee future performance. So please always do your own research prior to making any investment decisions. Now, today is going to be step number 4 of our Step into Sectors series. And the goal for this webinar is quite simple. What we are going to talk about is we are going to look at how we can use backtesting results. We'll go beyond just what we looked at last time, which was the total return of the strategy, and we'll look at a handful of ways to measure the success of our strategies. Then we'll talk about how we can export our backtesting results and put them into Google Sheets, and we'll use Google Sheets to do this analysis with a nice little party favor for you all, a way of finding these results and using these results by just clicking copy and paste. Hi Mayra, good to see you. Now, let's quickly review part 3 of our series. In part 3, we looked at a matrix strategy that trades on days of the week that aren't Thursday. Part 2, we talked about how to take that Thursday strategy and tweak and adjust it to meet our needs. But now we're looking at a strategy that trades using different matrices and trades on Mondays and Tuesdays. We're going to also cover how we can run backtests for these strategies and how we can we covered how we could gauge the performance to see if our strategies are doing better or worse than the market. We looked at the strategies for Monday and Tuesday and figured out that they weren't doing as well as we might have wanted them to be. They were holding cash a lot, and while they weren't losing money, they weren't keeping up with where our expectations and the market was headed. So we went through and decided how we can use the backtesting results to change our strategy and how those changes impacted the results and compared the new results and the old results to see just how far we'd come. Today, we'll answer a handful of questions. We're going to cover more details about what information is in the backtesting results that we get, how we can export the backtesting results, how we can import the backtesting results into Google Sheets for analysis, what basic information we can get from our results, and then finally, what do these metrics or statistics tell us about our strategy. We're going to keep things as simple as we can today, focus on only what you need and not what you don't. So let's go through and talk about what information is in a backtest. When you run a backtest on the matrix, which here I've got, Here I've got one all loaded up for us. This strategy, by the way, is the Tuesday strategy, trading one sector per week with the changes that we made last time. It is using a positive trend momentum for the 2-week table of 2. If you want to see what that strategy would look like to actually do it, what it would be is going here, sorting this table by 2 weeks ago, putting positive trend at the top, and buying the sector that has the largest positive trend momentum as long as that number is 2 or more. Right now, if today were the day we were trading, we don't see any sector that has that. So this would be a cash week for our strategy. That is the steps to do this strategy. These are the results since the beginning of 2022. We scroll down, we have the basic returns of the strategy, the returns over there, and then here we have how well SPY has done over the same period of time. Below this, we have a number of different columns. Let's go through each of these columns and talk about what they give us. The rebalance date is what day we traded on. So, if we see a rebalance date of January 4th, that means that the strategy looked at the matrix, made all of its trades on January 4th. It is not using the matrix from January 4th, it's using the matrix from the day before. It is the exact same as if you opened up the matrix before the market closed on January 4th, 2022. You went here, you did what we just did, and you picked the sector. So that is the day that you would have done all those steps. The buy date, when the trade began. It's always going to be the same as the rebalance date. The sell date is when the trade ended. So, when did the trade sell? All of these are going to be weekly. So you'll see you buy it, you hold it for 7 days. Buy it, hold it for 7 days. Reason? You can change how often you invest. You can change how often you look. So far in this series, we've talked about strategies that involve you trading once every week. But in our SMS Strategy Cookbook series, we do go into a little bit of detail about strategies that trade less frequently than once a week. So if you're interested in more long-term strategies, that series still does have quite a few great pieces of information. Let's continue. Strategy return. This is the one period, in our case, these periods are weeks, the 1 week profit or loss of our strategy. SPY return is if you had bought SPY, or how well did the market do that week. This is really helpful for us to know, because if we only made 1%, but the S&P 500 made 3%, I wouldn't really call that a win. To me, a win is when we make profit and we beat the market. That's the goal. So, SPY return gives us a way of seeing, in that week, what did the S&P 500 do? And return difference tells us that percent. If we take our strategy return, subtract the S&P 500 return, how well did we do? A positive return difference means we beat the market that week. A negative return difference means the market beat us that week. 2 more columns for us to cover. Strategy capital is the total value of our portfolio since we started our backtest. This backtest reinvests everything. So, if we look forward to this week, for example, we see that our portfolio, by the way, we started with $10,000. We set that up here. This is saying that our $10,000 this week had grown to $12,786.64. It then invests 100% of that value into the next week. So these gains are compounded. Weeks where we make profit, we add on and are constantly reinvesting that profit into the future weeks. And then finally, it shouldn't be SPY capital. Oh, sorry. It should be SPY capital. My apologies. This was if we had just bought and held SPY for the entire time. So back on January 4th, 2022, we bought SPY, and then we fell asleep until, well, wake me up when September ends. But we're close enough to the end. We're going to call this the end of September. I woke up right now and I checked my portfolio. So if I had bought SPY, fallen asleep, and then got woken up when September ended, but they missed a year, that portfolio would be worth $9,532.24. We lost just under 4.7%. So, that's what we have, and there's one last metric. What did we buy? It's pretty handy to know, what did the strategy buy that week? This could be a single sector if we're looking at a strategy that only trades one sector. For a strategy that trades two sectors in a week, we'll see that that can be one or two. They're separated by a straight down line. So let's take a look at what those results would look like. So here we see we have XLK, line XLY. So that week, the strategy bought XLK and XLY. Cool? Cool. Next step. How can we import the data? There are a couple of answers. Really, the data is exported as, well, I'll get to that in a second. But right now, let's just say we're going to use Google Sheets for today. Google Sheets, what we can do with this is that we can open a spreadsheet, and to actually download it, not sure why that step's missing. What you do is you go down here, you click export, and then you would download as a CSV. I need to refresh my client really quick. Cool. So we're going to run this backtest, and then we're actually going to download it. So remember, for this strategy, we are using a positive trend momentum of 2 or more for the 2-week momentum, and a total count, doesn't matter the number. So what this is saying is we want to look at our positive trend momentum of 2 weeks. We'll buy the one sector that has the highest. If there are 2 sectors that have the exact same positive trend 2-week momentum, we'll take the one that has the higher total count. So let's run this backtest, and then we will download the results. So we go here, export, download as CSV. What that does is now we have in our downloads folder the file. That file is a file type known as a CSV. You don't care about that. If you know what a CSV is, then you probably also know where CSVs can be imported. It can be imported into Python or other coding IDEs. They can be put into Google Sheets, Excel, and more. But if you try and just open a CSV, it's gonna look a little ugly. It's a little bad. So we need these programs to turn this into something that looks like this. And it's really easy. All you have to do is you go to sheets.google.com and you'd click blank spreadsheet. Doing that would give you something that looks a little bit like this. From here, to import our results, we can click File, Import. So let's go ahead and do that together. File, Import, and we're going to click Upload. From here, you can either browse to find where the file is. I'm not going to do that. I'm going to just drag and drop the file from the other side of my screen. So I'm going to take that file that we just downloaded and drop it right here. You're now going to get this. Most of the stuff here we can just leave alone. For import location, you have two main options. You can either replace the current spreadsheet, it's going to delete everything here and put in it all of the information, or the other one I use is insert new sheet. This will not delete anything, so if we go ahead and say, I'm here, and we go to import, if we do create a new spreadsheet, it's going to give us a completely new place. If we don't want that, if we want to still have it here, we can do insert new sheet. Now at the bottom down here, these are called tabs or sheets. We have sheet 1, I'm here. And we have sheet 2. The names for these files, by the way, are long, but they're really helpful because they tell us what the backtest was for. So this strategy was a positive trend momentum of at least 2, total count of at least 2. Positive trend momentum of 2, total count of at least 2. So from here, again, I prefer new sheet. The last step is click import data. Now, what can we do with this data? We can do a whole lot. Just to show you what it can really look like when we get super into all of this data, let me pull up a spreadsheet. This spreadsheet here is a perfect example of the places you can go with Google Sheets. We have our backtesting data here, and if we go to our other sheet, we'll find that looks very similar. Because it's the same thing, just different strategies. Then, what we can do is we can import real stock prices. So this spreadsheet I created to test if it's possible to trade that Thursday strategy. Remember that graph I showed in episode 2 of Step Into Sectors? All of that I got from exporting a backtest and then doing analysis with it. I calculated prices using a formula called Google Finance. We then used those returns over time to get our other lines, the market open Thursday and market open Friday lines. So there is a lot of advanced analysis you can do using Google Sheets, and if you're interested in analysis and you want a guided tour of analysis in Google Sheets, we do have our Spreadsheets Made Simpler series. The first few episodes are available for free at learn.sectorsmadesimple.com. Future episodes we have put together teaching you how to build a stock screener in Google Sheets. That series is available for purchase at sectorsmadesimple.com, called Spreadsheets Made Simpler Advanced. But back to what we're covering today. We're going to use all of this information to do analysis, to figure out more information about this strategy. So again, data analysis can go as deep as you want or as shallow. And we're going to go one step deeper than surface level here. I want to give you guys something you can really use. So we want to give you a good starting point. Again, this isn't as deep as you can go, but it's going to be a little bit more than just return. Why? Because we want to know more about these strategies. We want to understand more. We want to understand details. We want to understand how profitable, how much risk there is in the strategy, how consistent the strategy is. And also, we want ways of comparing our strategies. It's great if we can compare strategies to see which one we prefer. So, I've picked out a handful of pieces of information, metrics, for us to cover. So let's go through each one of them and talk about why we have this. Let's start incredibly simple. Total return. This one's pretty easy. It's the same thing as we see here. How much profit or how much loss did the strategy have from the start to the end of our backtest? Why do we have this? It's darn simple. We want to know how profitable it is. Over the period of time we're testing, we want to know how much money did it make. There's a reason that if you want to compare strategies, you end up doing a whole bunch of backtests and running those backtests multiple times to compare the results. This is going to be the biggest metric that most people are going to look at. But now let's go one step further. Worst week. The reality is, strategies will have good weeks. Strategies are going to have bad weeks. And any strategy, much like the stock market, will have a period of losses. That is inevitable. We look at this strategy here. It had a bumpy 2022. Did it outperform the market? Consistently. But it was not immune to losses. Losses will happen, and this number will tell us what the worst period or worst week that we had, shown as a percentage. We calculate this by going to the strategy return column and finding the smallest or lowest number. Why do we have this? We want to know what's the worst it can get. We buy sector ETFs for one reason, because they are diversified. They are supposed to be a gift basket of many different companies. Part of that is to avoid risk, that one company could have a really bad few weeks and drag down its stock price. For example, let's look at NextEra Energy. Its 1 month is 15% down. If you were invested in one stock, that would be a 15% loss in a single company. We try and pick sector ETFs to diversify and avoid that risk, or minimize that risk. But sectors can still have really bad weeks, and this will tell us what the worst week in our backtest has been. Then we have best week, which is the opposite of worst week. It looks at the biggest number. Then we have average week. Because not every week is the best or the worst. Average week just does exactly what the name tells us. It helps us to know, on average, what the returns of the strategy have been. It turns that super up and down line that we get, this bumpy path to success, it turns that into a big straight line up, tell us what our trend has been over time. We find this by calculating the average of the strategy returns. Keeps it nice and simple. But the real reason that I love this metric Looking at total return can be different. It's not fair to compare the results of 6 months to 6 years. You have a lot more time. If you're reinvesting, that's a lot more time to compound your growth. That's why I always emphasize run multiple backtests with different start dates. But you still want a way of comparing them all. Average week does that. We forget what the total return is. All we look at is over time, what was the weekly change in the value. That weekly change could be for the 1 week. It could be over the entire duration of our backtesting data. But by looking at the strategy returns every week, we can compare week by week how well a strategy did. Now, this one is a little tricky to talk about because we start getting into some real statistics. Volatility. To keep this really surface level and just give us what we care about and nothing more, it's a way of figuring out how consistent a strategy is. A strategy with higher volatility will have more inconsistent returns. You'll have bigger bigs, lower lows, and there's going to be a lot of bouncing in between. A strategy that is a straight line up will have extremely low volatility. A strategy that went up, down, up, down, up, down, much higher volatility. So, higher volatility means a more bumpy ride. Volatility is represented as a number. That number can get really small, so we multiply it by 10,000. But the reality is, we shouldn't focus as much on the raw number. If you understand the number, great. Get rid of the 10,000, use the actual volatility metric. If you don't care, you don't know, just know this. Bigger number, more volatility. Smaller number, less volatility. Why do we have this? If we're comparing strategies, it's nice to know which strategies are more or less consistent. Higher consistency, lower volatility, less surprises. Simple. Now, let's go back to the easier stuff. Number of losses and average loss. These two go hand in hand. Number of losses goes through and counts up the number of weeks in our backtesting return where the results of that backtest were negative. Straightforward. Average loss only looks at weeks that we lost, and it takes the average of those weeks. So it ignores cash weeks, and it ignores weeks where we won. This number gives us an idea of how often our strategy trades at a loss. So how many weeks did it lose? And when it lost, how big were its losses? The reality is, this number on its own is not that useful. We need a way of comparing those numbers. What better way than comparing it to our wins? So, same idea, opposite direction. How many weeks in our test were the results of the strategy positive? And only looking at the positive weeks, what's the average profit? Why do we have this? Because now we can compare. We can compare the number of losses and the average loss to the number of wins and the average win to know how often the strategy profited and how big or how small those average wins and losses were. Our goal here is to find a strategy that wins more often than it loses, and when it wins, it makes more money than it loses when it doesn't. Straightforward, simple to understand, but still extremely useful for us to learn from and compare different strategies and compare a strategy and evaluate a strategy on its own. Then we have win-loss. This is the final metric, and it is probably the easiest. How often did it win compared to how often did it lose, expressed as a percentage. These higher percents means it won more often than it lost. For example, a win-loss of 75% means that the strategy won 75% of the time and lost 25% of the time. So 3 weeks it made profit, 1 week it lost. It should be noted, the number of losses, number of wins, and win-loss, all of these ignore cash weeks. Cash weeks are 0, and we don't look at those weeks at all. We ignore them for these tests. When we're looking at strategy returns, the average strategy return, that does include cash weeks. So the average return over time includes cash weeks, our number of wins and losses, and this win-loss percentage, ignore them. Why do we have this? It's a percent version of those number of wins and losses, and because it's a percentage, we can compare the strategies, or the win-losses of different strategies that have different start and end dates. Alright, we went through a lot, but hopefully it was fairly simple. We're not trying to do rocket science here. We're not trying to create some crazy complex calculation. Keep things simple, keep them understandable, and keep them usable. And explain to you why we have them and how we can use them. But this is Step into Sectors. It's meant to be a stepping stone. But the world of analysis is a lot deeper, and if what we've done today is interesting to you, and you want to learn more about analyzing backtesting data, do check out our SMS Strategy Cookbook series. There, we provide some additional statistics that allow you to gauge a strategy's performance. One example that I have for you is called cash accuracy. What that does is when we hold cash, it looks to see, did SPY go up or down? If we held cash and SPY went down, that's a thumbs up. It saved us money. If we held cash and SPY went up, it didn't lose us money, but it lost because it did worse than the market did that week. The other option that we can use cash accuracy for is looking at investing in inverse ETFs. So, instead of holding cash for a week, if a strategy has a really high cash accuracy, it's really good at predicting when the market is going to go down. What if we just bought an inverse ETF of SPY? So take those weeks that SPY in the market went down, and instead of just holding cash, invest in SPDN, an inverse ETF of the S&P 500. So if SPY went down by 3%, SPDN would have closely gone up by 3%. Not exactly, but similar. Again, backtesting can be as complex or as simple as you want it to be. Last week we kept it simple. This week we went one step further. The next step, if you want to get more into backtesting, would be checking out our SMS Strategy Cookbook series and finding out the strategies that we've created using cash accuracy. Now, onto our spreadsheet. This spreadsheet is the party favor for today's webinar. You can use this spreadsheet to quickly and automatically calculate everything that we've talked about today. Let me show you. Here was our backtesting returns, and there they go. I'm going to pull up the backtesting analysis template, and I'm going to show you how we can use it. First, I'll show you what it is. Let me make this window a little smaller so we can still get our translations down at the bottom. Cool. When you first open up the template, you're going to see a nice little introduction. It's going to mention a lot of the stuff we talked about today. It's going to talk about the steps to use it. I'm going to also go through all that right now. I'm not going to make you have to read it twice. The juicy part. Here are the metrics we've covered today. Total return, worst week, best week, average week, volatility, number of loss, number of win, average win, and win-loss. Simple. And there's a nice little key. If you forget what any of them are, you have this right here to remind. Up above, there's a bunch of formulas. You don't really need to worry much about the formulas because as soon as you paste in a backtesting result, it will populate automatically. All of these numbers will calculate. So to actually do that, or to make your own version of this sheet, let's first cover that. And then actually I'm going to give you the sheet so we can do this all together. Link. So now in the chat or down in the resources section of the video or comments, depending on where you're watching this webinar, that is the link to this sheet. To make a version that you can edit, go to File up in the top left and make a copy. This will let you create a version that you can actually change. So I'm going to make a version that I can edit, and we can use this for today. Now, what I will say, please do not request edit access. That will let you change the version that everyone else has access to. Can't do that, I'm sorry. So, to make your own version, file, make a copy. If you're having problems, send us an email at support@sectorsmadesimple.com. Our email's right down here. Let's talk about using this spreadsheet. To import our data, we're going to follow the steps we talked about earlier. And for import location, we're going to insert new sheet. So, you want to join me for this? File, import to upload, browse, or just drag the file in. And what I'm going to do is I'm going to take the backtesting results from that strategy that we just ran. And I'm going to choose the import location as insert new sheet. Come back. Open. I'm going to click import data, and automatically there. So now, down at the bottom, we have 3 sheets. Intro and help, paste data here, and our backtest. To take our backtest and get all those numbers, we need to get all of this information. Depending on your level of comfort with Google Sheets, you can either highlight all of the columns by clicking on A, holding Shift and clicking on I. You can copy that. You can manually click and drag to copy all the information. Copy that. Or you can do Control A to highlight all the data and copy that. However you want to do it. Copy it, and then, big surprise, we're going to go to paste data here. And watch this. This is how easy it is. See what it says here? Click on cell G1 and hit paste. That's it. Here are the results of our strategy. You'll now see all of the numbers that used to just be blank our now stuff. By the way, once you import your backtests, I recommend right-clicking on the tab, clicking delete. We don't need that anymore. It's right here. We now have our total return, the worst week we had, which was an 11% loss in a single week. Sector ETFs can have really bad weeks, but they can also have really good weeks. We had a week that we gained 9.46%. Our average week return was 0.42%, and our volatility was 9.36. Volatility to you right now means nothing, but once you add another backtest, it now has some context. We need more backtests to use volatility. The strategy lost 29 weeks with an average loss of 2.54%, but it won 49 weeks with an average gain of 2.26. So our strategy had lost more when it lost than it won when it won. When it gained, then it won. Won, then it moving. Words are hard. There's a reason I love numbers. But the reason that this strategy was still profitable is because its win-loss was 62.8%. So, almost 2 out of every 3 weeks, this strategy was profitable. So even though the average win was smaller than the average loss, it was still profitable because our win-loss rate was so high. So, that's a backtest, and we did no math. We copied and pasted, and everything else was done for us. Let's add another backtest. Let's add our Monday backtest. So we're going to take the same strategy, and we're going to add the one from Monday. Have I had the page open too long? You going to cooperate? You will cooperate. Export. Download as CSV. File. Import. Upload. We're going to browse. I'm going to do that on another screen. Trust me, you don't want to see all the times I've downloaded backtests. I do this way too much. It's really fun. We're going to go to our downloads, drag in the results of our backtest, insert new sheet, and import. Now, these are all the steps that we just did. We want to have them listed. Now we need to talk about how do we add more backtests. Because if you want to add more strategies, you need to do one more step. Click on the Paste Data Here tab, and click Duplicate. You'll now see Copy of Paste Data Here. If we make another copy, it's going to be copy of Paste Data Here, and pretty soon it ends up looking like one of those emails that you got forwarded from your abuela. It has forward, reply to, all of that before you even get to the point of the email. You all know it, you've all seen it, or you've been the one sending it. Either or, let me show you an easier way to name it. Right-click, rename. Remember, this was our Tuesday, one sector. Let's now go here, and this is going to be our Monday, one sector. Why did I name those? Because we're only trading one sector a week. The first backtest we did traded on Tuesdays. This one traded on Mondays. To import the new results, choose your method of copying. Choose your method of pasting. Always click on cell G1 to paste the results. If you paste them here, everything's going to break and we're going to be sad. So click G1, click paste. There's all your stuff again. I did skip a step here, and luckily it didn't break anything. I would recommend always clearing these columns. Delete everything to the right of G1 before you make a copy. Or make a copy and then delete it. Either or. This number, the total return, and all of them, if your backtest is shorter than the one you had in there before, you might have a few straggler weeks at the end. We don't want that. So, here's our results from Monday. Total return, worst week, best week, average week, volatility, number of losses, average loss, number of wins, average win, win-loss. Our return doesn't tell us the whole story, right? 32% to 38%. But the win-loss went from 62.8% to 58.67%. Our volatility went from 9.36 to 9.88. It's more volatile. Our worst week wasn't as bad, but our best week also was not as good. And our average loss and our average wins are bigger. Again, you can flip between these two tabs. And because all the numbers are in the same place, you can see how they change over time. We're going to do one more example here. We're going to go to our Tuesday backtest, and we're going to choose 2 sectors per period. Export, download, import, upload. Find the file, drag the file, insert new sheet to file. At a certain point, you start getting pretty quick at doing this. And the steps are exactly what we've done before. So now we're going to rename this one Tuesday 2 sector. Copy. Paste. So, let's go through. Total return, 27.87%, down from 38.76% return. Okay. Worst week, not as bad. Best week, not as good. And we're comparing right now, I'm flipping between the 2 sector and 1 sector. Average week, lower, but looky here. Volatility has gone from 9.36 to 7.68. Yes, the strategy had lower returns, historically, but it was more consistent. It didn't have as big of bigs and as small of smalls. It had a straighter line to success. And does that make sense? Let's just think about it. Does that make sense? Yes. If you're investing in 2 sectors, you're diversifying. You're not putting all your eggs in one basket. That's why diversification is important. If you really want to get into diversification, I highly recommend for Sectors Made Simple subscribers, I have a series called Building a Portfolio. In that series, I talk about why having a matrix strategy shouldn't be your whole investment strategy. You should diversify, you can diversify, and I show many ways that you can diversify. Invest inside the US and outside. Invest in stocks and non-stocks. Invest in strategies, but also invest long-term. So, if you're interested, highly recommend the Building a Portfolio series. Jonathan, when you choose 2 sectors, how do you decide how much to invest in each and every one, or in each one every week? The backtesting does 50%. So a backtest that trades half and half trades 50% XLE, 50% XLP. Great question. So again, how do you add more backtests? Paste data here, click duplicate. You can rename it if you'd like, and that'll help you track different strategies. So now you can flip between them and see all of the different information. If you want to play with this yourself and you want some ideas of where to go, try adding backtests that are 2-year-long backtests and 1-year-long backtests. Try adding different strategies entirely. Try adding the Thursday strategy on top of this. Try out new strategies. Go check out our Building a Portfolio, or our SMS Strategy Cookbook series. Take some other strategies from there and plug them in. This template can take any backtesting results you want. Try it. Use it. This is now a tool that you have in your tool belt. And the best part, you understand how to use it and how the different numbers can be used to compare different strategies. Like we just saw, this strategy was not as profitable, but it was much more consistent. So if you're the kind of person that likes avoiding risk, a strategy that will give you more consistent returns might be more your speed. If what you want is to go full speed ahead, you're willing to accept bad weeks and good weeks, and you want the best returns, you can also look at that and get those numbers. As a reminder, if you're going to look at backtests from different periods, so 2-year or 1 year, that's where the average loss and average win and win-loss start to be a little bit more important. And average week. Average week should replace your total return as what you are focusing on. Because total return, it's going to only give you half the story. Average week will tell you what that average every single week was. That average could be from 6 months of data or 6 years worth of data. Alrighty, everyone. If you're still here, you made it. So that wraps up step number 4. And this is going to be the end of us getting into backtesting. We've gone fully through how to learn a matrix strategy, and I quickly want to look back at how much we've covered in 4 episodes. And again, if you're looking at all of this saying, too much, don't care. Don't worry. I don't expect that you watched video 1 and in 1 week you were ready for video 2 and ready for video 3 and ready for video 4. I'm recording these 1 every week, but that process can and should take time. The goal of this series is not to say you need to learn every single one of these for the next week. It's to make sure that when you're ready to take that next step, we're here. These videos are here. They provide some direction and some idea of where you can go. But now that you're here, let's take a quick second and look back at how far we've come. In step 1 of this series, we talked about a simple to follow matrix strategy that trades every week. The goal of that strategy is to give you something simple to start with. In lesson number 2, we talked about how we can make small changes to that same strategy to fit our needs. We looked at, can we trade that strategy? Can we place our orders Wednesday night to be filled Thursday? If I know what the leading sector was and I just forgot to buy it, can I still buy it Thursday afternoon? And if I do, what's the risks? Lesson number 3. We talked about the fact that there are strategies that trade on days that aren't Thursday and use matrices that aren't Wednesdays. We talked about strategies that traded on Mondays and Tuesdays with quite a bit of success. But those strategies underperformed the market in 2023, so we looked at how we can look at backtesting and run backtests and find some reasons why the strategy was not performing well and how we can improve the strategies using a little bit of critical thinking and common sense. We then took those strategies that we covered in Lesson 3, exported their returns, and imported them for analyzing in Google Sheets. That's how far you've come. Great job, everyone. Now, here's step 5. Because step 5, we're going to put what we've learned now aside and look at some more ways to use Sectors Made Simple's tools. Everything I've shown you here uses one tiny little part. It uses this page and it uses this table. That's it. But we have a wide range of other tools. And while I don't want to overwhelm you with, here's everything else we have, good luck, have fun, I want to continue answering questions with you. Once you've gotten comfortable with understanding what relative strength is, understanding what the matrix is, and you're starting to think about those numbers a little bit more, let's try and answer the question, what is the best sector to invest in today? This question has many answers, and the correct answer will depend on what your specific goal is. So, in step 5 of Step into Sectors, we will take a break from our matrix strategies and we will look at answering the question, what is the best sector? Based on what you need. Do you want to find the leading sector in short term? Do you want to find the leading sector in the long term? Or do you want to find the best sector to look at for investing in companies? So if you're interested in trading companies and you want to buy companies in the leading sector, how can you use Sectors Made Simple to do that? So, thank you all so much for joining. I hope you enjoyed this deep dive into the world of matrix strategies. Again, if you want more detail and more strategies to look at, I do highly recommend checking out our SMS Strategy Cookbook series. But from all of us here at the Sectors Made Simple family, thank you all so much for joining us today, and we hope to see you all back next week for step number 5. Take care. Have a great weekend.